Did you know that the biggest source of a bank's income is also the biggest source of risk? My name is John Martin, and I'm a risk management consultant. In this video, I will take you through two things. Number one, how to understand banks or financial institutions by understanding their lending portfolio, or said another way, by understanding the total loans granted by a financial institution. Number two, why the bank's lending portfolio is their greatest source of risk, which is also known as the credit risk. What is credit risk? Now, credit risk is the probability, or shall we say, the likelihood of financial loss as a result of a customer's inability to be able to repay the loans that have been given and the interest as well. For example, it is on record that by the end of 2023, banks had lost total of Kenyan shillings 634 billion in default. This is the total amount that the customers did not pay, or shall we say, failed to pay. Banks, you can remember that they are in the business of lending, and so therefore they cannot be able to avoid risk because they have to lend to, individuals, and they have to lend to business as well, so that they can actually be able to grow the economy. Considering that, then credit officers, they must do a number of things. One thing is for them to manage credit risk. The other one is to also maintain customer relationships and, of course, adapt to the changing market conditions. So there are actually three folds. So let me break this down further in terms of the challenges that credit managers or credit officers face whilst doing their lending business. Now, one is the aspect of risk management. Now, in terms of risk management, we have to look at the aspect of balancing sales and risk. In as much as the banks want to, increase revenues, but they have got to consider the fact that there is a risk which is related to this. There's the risk of default, which is actually related to the lending. So that is a challenge. The second challenge is assessing the creditworthiness, assessing the creditworthiness of the customers. Now, this will require effective strategies and also a number of tools that they are going to use to be able to gain tactics that will in fact support them in making recoveries. Data quality. If we don't get quality data, then it means that it is possible for us to rely on wrong data, and this can create wrong decision making. We also have a challenge in terms of regulatory compliance. In terms of regulatory compliance, there are many regulations which are, which are being set forth by regulators. For example, Central Bank of Kenya, for example, SASRA in the case of SACCOs, and the credit managers or credit officers need to actually be able to comply and understand these evolving regulations. Now, let's come to the customer relationships and market dynamics. So, when we are maintaining customer relationships, it means that the credit managers need to, or credit officers, they need to build customer relationships so that they can have a successful credit. Because without a good relationship, then it means that even the negotiation would actually become difficult. Adopting the changing market conditions. Now, it is important for credit managers to be able to keep pace with the changing economic cycles, the changing industry trends, and of course being able to adjust to their credit policies and credit procedures so that they can be able to meet such kind of challenges. Navigating economic downturns. When the economy becomes cyclical, for example, then it becomes important for credit managers to be able to be skillful enough to understand how defaults can occur in such kind of situations. The difficulty in terms of managing the customers, delinquent customers, proper negotiation skills are also extremely important. Now let's look at now the aspect of technological operations, technological and operational challenges. Now, in terms of technical and operational challenges, you find that it is important. We have things like cybersecurity. Now, it is important to protect against cyber threats, you know, and this is something that is growing, and so therefore data security is actually important. The other aspect is data quality and data availability to ensure that we now need to have essential, rather, to have timely data is a matter that is very essential insofar as credit risk management is concerned. And we have also automation and digitization. Now, in terms of we're talking about tools. Yeah, they require tools. The credit officers now will require tools and digital transformation so that they can be able to optimize and leverage on technology to be able to make appropriate credit decisions. Then, of course, we now have skills, the staff skills, like, for example, professional skills. You realize that in terms of credit risk, there are these diverse skills which include statistical modeling, data analysis, and risk assessment. Now, these are usually very, very challenging to find skill sets that can be able to manage all this. So, these are basically some of the challenges that are causing the bank's largest source of income or biggest source of income to be, again, the biggest source of risk. So, thank you very much for watching. Until next time, keep subscribing and ensure that you smack on the like button.